In April of 2020, I decided to finally start investing in the stock market. Now, this is my portfolio to date, and these are the returns that I got. But I was scared, and maybe you're scared too. And if you're watching this, I probably actually had the same fears that you are having right now. So, together with Kozan, a really great financial YouTuber, I will elaborate on the 3 reasons that I thought I shouldn't invest in the stock market.
Thanks, Mike. Hi everyone, I'm Kozan from the Financial Madness YouTube channel, and I have now invested across a few platforms, and my portfolio has grown by 25%. That's an average of about 7% per year, which massively beats any savings account you'll find currently. Before we go any further, I should stress that neither me nor Mike are financial advisors, and this is purely going to be for educational purposes. For any further questions or guidance, we do recommend that you speak to a professional.
Reason number 1, I don't read the Wall Street Journal. Now, 6 years ago, I did something that almost got me disowned by my extended family and divorced by my immediate family. I stopped reading the news. The last headline I listened to on Radio 4 was uncertainty surrounding Brexit, and went cold turkey for exactly 1 year. I discovered podcasts, audiobooks. I even wrote my own audiobook. And then after 1 year, I turned on Radio 4 again. And do you want to guess what the headline was? Yeah, it was uncertainty surrounding Brexit. So I mean, who am I to mingle with the wolves and play their little money game? I was scared that I was gonna get eaten. It's like, I don't know the price of oil, and I don't know who's merging with who, or should it be with whom? So how can I invest in the stock market? And who should I invest in? I mean, is Nintendo on the stock market? Nintendo? Because I really like Nintendo. Kozan, please explain.
Look, you don't have to buy Nintendo stock, and I probably wouldn't recommend picking stocks purely based on whether or not you like their product. One of the easiest ways to get started in investing is by putting your money in something called an index fund. An index fund is an investment fund that follows a benchmarking index. Some famous indexes that I'm sure you would have heard of is the S&P 500, which is made up of approximately 500 of the largest companies that are listed on the US stock exchange, or for us Brits, you've most likely heard of the FTSE 100, which is a list of the largest 100 companies listed on the London Stock Exchange. So for example, if you are investing in an index fund that is following the S&P 500 index, you are investing in all of the companies that are in that list that make up the largest 500 companies in the US. So this will include big companies such as Apple, Microsoft, and Amazon. So if these companies are doing well, your index fund will grow in value. And if some of the companies aren't doing so well, you still might see some growth in your fund, as you're likely going to have some companies that will have performed really well, and that would have made up for some of the losses other companies would have made on your portfolio. Investing in index funds is great for beginners because A, they are relatively low cost, because essentially all they do is copy the benchmarking index. B, you don't have to worry about finding which specific stock is worth investing in, because instead what you are actually doing is investing in a basket of stocks, so you are more diversified, which can help mitigate the risk of losing money. And finally, C, you don't actually need that much money to get started. Some platforms allow you to get started from as little as £1. We will be sure to link some of these platforms in the description box down below so you can take a closer look.
Here's reason number 2. I don't believe in a quick buck. I'm a medic, I'm a GP, and as medics, believe it or not, we believe in hard work. So you want money, you take that extra night shift, you do the out of hours, you do honest work, none of this stocks and shares nonsense. That's how I was raised, and maybe that's how you were raised as well. And when you do those extra shifts and you get some money, you put it in the best savings account you can find and keep it safe in the bank. So I used to religiously read Martin Lewis's Money Savings Expert newsletter and got the best savings account I could find, only to later understand that that 1 to 2% that I was actually saving was less than inflation, and that I was losing money in real terms.
For a quick 101 on what inflation is, it is simply put the steady increase in prices. For example, a loaf of bread that used to cost you £1 now costs you £1.50, or that studio flat in London that used to cost £200,000 now costs £300,000. Inflation is the silent killer of wealth. If everything is going up in price by 8% and you're holding your money in a savings account that's only returning you 1%, then you have lost 7% of your wealth. That's why it's really important to find means to generate a return on your money that is larger or at least equals the rate of inflation. And the stock market can be an excellent way to achieve this. If you look at the history of the S&P 500 between the years 1950 to 2021, over the long run, the average annual return on the S&P 500 was 11.53%. 8%. Now this number is really impressive, and it's even more impressive when you consider that this period covers many recessions, including the dot-com bubble crash in the early 2000s, the famous 2008 financial crash, and even the COVID-19 pandemic, thus demonstrating that we shouldn't think of investing in the stock market as a get-rich-quick scheme, but rather it is best to go into investing as a long-term strategy. Yes, there may be a few bumps along the way, but overall it is highly likely that wealth will continue to grow if you invest in the long run. Now this 11% number that I just quoted is of course achievable, but it's more common to see an average growth rate of between 6 to 8% in the long term, which still massively beats the inflation rate when they are stable at around 2% on average.
And finally, reason number 3, and please bear with me on this one. What if the global economy collapses? And to finance people, I mean, this statement probably doesn't even make sense. This is exactly how I worded it in my head. I invested in the midst of the COVID-19 pandemic. I was worried that the world would somehow collapse and that I would lose all of my savings and realistically just become another family anecdote. But then I stumbled across an amazing podcast called Invest Like a Boss. And that is actually the real name. And they had an answer to this exact worry. So what they said is, if the global economy collapses, well then money probably won't even matter anyway, because we're just going to be living in bunkers eating canned beans. And that really kind of got to me. And I was like, well, what the hell?
The truth of the matter is markets will always crash. They are inevitable. It is part of the economic life cycle, and yet markets have always recovered, and by having a strategy of investing in the long term and doing your research, you will most likely be fine.
Right, that's it guys. I hope that was informative. Be sure to check out Kozan's YouTube channel. He has an amazing video explaining the NHS pension scheme, and I'll leave those links in the description below.
And if you did find that useful, give us a thumbs up and like this video, and also hit the subscribe button on both our channels.
And if you now know why to invest in the stock market and you want to learn how to invest in it, leave us a comment below and we'll see what we can do for you.
Exactly. And I just want to say thank you for Mike for inviting me on your channel, and I'll catch you all later.
Good luck.